Factorings and Ram Berhad charges a monthly interest of 8% on any unpaid amount after 3 months. A. Berhad bears all the liability for bad debts. C. Berhad entered into a factoring agreement with D due to cash shortage issue. In accordance with the agreement, D. Factorings and Ram Berhad paid a fixed amount for the receivables, and C. Berhad had no rights to collect further sum from the factor. Okay, so before I explain about the accounting treatments for such an arrangement, let's just learn a little bit what is debt factoring. Okay, I will emphasize further on Wednesday. So debt factoring basically refers to debts, debt finances which involves either pledging receivables or selling receivables. Okay, so this is what we meant by debt factoring. It's a debt finances which involves either pledging receivables or selling receivables. What does it mean by pledging receivables? Pledging receivables means that in the event you want to get or you want to obtain a loan, you want to borrow a loan from a bank. So bank, they will usually ask you to pledge something, okay, in order for these people to release the sum to you. Okay, just like ourselves, if we want to buy a house, they will ask us to pledge the house to them. So in order for them to release the money to us. So in the event that, let's say, we are unable to make any repayment anymore, then the bank will have the rights to sell the house. Okay, so pledge receivables is almost sharing the same concept, whereby you will have to pledge your receivables with the bank in order for the bank to release the money to you. So any monies collected from this bank, basically it belongs to them. All right, so unless you are able to make a repayment on the amount that you have borrowed from this bank, or else any collection from the receivables, the money will solely belong to the banker. All right, that was what we meant by debt factoring. Now, what are the items that we need to consider before we want to identify whether it is pledging receivables or selling receivables? Okay, so there are two factors to consider. Okay, number one, control of the receivables. Number two, amount received from the factoring company is in a form of loan or not. So these are the two factors in order to consider whether this is considered as a pledging receivables or selling receivables. So control of the receivables. In the event that company is still controlling the receivables, we consider that this is a control of receivables. The control has not been transferred to the third party. All right, so that we consider as a pledging receivables, whereby we only pledge to you temporarily. Okay, after we have repaid everything to you, we will be getting back our own receivables. Okay, so that is what we meant by control. So if you are selling receivables, okay, we can consider that the selling of these receivables involves a loss of control. So this concept is very similar to your IFRS 15 revenue from contract with customers, whereby we have risk and reward test, we have control test. Okay, so here we are applying to the control test. So in the event that you have sold your receivables out, you would not have any rights to the receivables anymore. Okay, so the bank can do anything with your receivables. Okay, so that is what we meant by a transfer of control. Then in this condition, we consider it as selling receivables. The second factor to consider is that the amount received from the factoring company, is it in a form of loan or not? Now, if you are only pledging receivables, the concept works the same as if this is a loan. All right, that's why pledging receivables, we consider that you borrow a sum of money, you pledge something precious to the bank in order for these people to release the money to you. Okay, so we consider that the amount of that you receive from this factoring company is considered that it is in a form of loan. But if this is a selling receivables, then the amount received from the factoring company is considered as a one-off payment. Okay, so like selling things. Okay, I buy from you, I pay you money. This is considered as a one-off payment. You have lost your rights over the inventories. I gain control over your inventories, which eventually it becomes mine now. All right, so that are the two factors that you need to consider, whether this is a pledging receivables or selling receivables. Okay, so now let's move on to the first question already. Yeah. Okay, so before I move on, any questions that you want to ask me? Is that clear for everyone? Sorry, can raise your hand if it's clear. Okay, thank you. So if it's clear, then I will move on to the next. Okay, so the first question here, A. Berhad entered into. Yep. All right. Thank you, Jing Hui. Okay. A. Berhad entered into factoring agreement with B factoring Sendran Berhad. So we already know that there is a factoring agreement involving here. According to the agreement, A sold trade receivables with carrying amount of 8 million to B for 7 million. All right. And any debts are not paid within 3 months, advance paid for those debts must be repaid to the factor. So let's collect some evidence first in order for us to consider the two factors as above. Evidence gathered from the information. Okay, so according to the information, number one, trade receivables are sold at RM 7 million. Okay, with carrying amount of RM 8 million are sold at 7 million. So this is the first evidence that we gathered. The second evidence that we gathered is that the debts are not paid within 3 months. Advance paid for those debts must be repaid to the factor. If debts are not collected within 3 months, advances received must be repaid to the factor. Okay, so now we have second evidence gathered. The third evidence, they also mentioned that any unpaid amount after 3 months, B Factoring Sendran Berhad charges a monthly interest of 8%. Okay, monthly interest of 8% charge in the event debts are not fully collected within 3 months. Okay, so these are the third evidence that we can gather. And the last evidence here, A. Berhad bears all the liability for bad debts. So A. Berhad bears all the liability for bad debt. Okay, so these are the 4 evidence that we can gather from the information. All right, so now after we have gathered all the evidence, we will have to consider the 2 factors as above. So we have 2 factors to consider based on the evidence. Number 1, control of the receivables. Okay, so control of the receivables, it still belongs to whom? Is it belonging to A. Berhad or it belongs to B Factoring Sendran Berhad? Is there a transfer of control from A. Berhad to B Factoring Sendran Berhad or not? So based on all the evidence that you have gathered, A. Berhad bears all the liability for bad debt. So based on this point number 4, we know that control of the receivables maintained in A. Berhad. Okay, refer to evidence 4. Okay, so your evidence 4 has told everything. So if A. Berhad still bears all the liability for bad debt, you know that the receivables still belong to A. Berhad. So the control of the receivables still maintained in A. Berhad. So the next point that we need to consider, amount received from the factoring company is in a form of loan or not. All right, so from here, we need to look at the points from number 1 to number 3. So point number 1 tells you that it's sold. Point number 2 tells you that the debts are not collected within 3 months, advances will have to be repaid. And point number 3 stipulates that there is a monthly interest of 8% charge. So based on point number 2 and number 3, we can conclude that the amount received from the factoring company, yes, it is in a form of loan. So you can refer to evidence 2 and 3. Why? Because the mechanism of loan is very similar here. So in the event that the debts are not collected within 3 months, advances received must be repaid to the factor. So the mechanism of a loan is similar. In the event that you borrow money from the bank, you are required to repay to the bank. So here there is a repayment, okay? Monthly interest of 8% will be charged. So this mechanism is also similar to borrowing of a loan. When you borrow money from someone, basically they will charge you interest, especially if you borrow from the bankers. They will charge you monthly interest rate. Okay, so here you already know that amount received from the factoring company is indeed in a form of loan. All right, so after you have considered these two factors, now you can already create your own hypothesis. All right, so your hypothesis number 1, control remains with A Berhad. Okay, so this is number 1. Number 2, since the control remains control of trade receivables, yeah, let me just trade receivables remains with B Berhad, remain with A Berhad. So since we know that the control of trade receivables still remain with A Berhad, the advances received from the factoring company is in the form of loan. All right, so since we know that these advances received from the factoring company is in the form of loan, this is a full recourse to the seller. So if you want to know what does recourse mean, recourse means assistance. So this is in a form of assistance to the seller, just like you get borrowing from the bank, which means you need assistance from the bank. So full recourse means it's a full assistance to the seller. So the advances received is also in a form of loan only. So in this picture, after you have created your 3 hypotheses, we can say that trade receivables still maintained as an asset as an asset in A Berhad's SFP, statement of financial position. Hence, the recognition of trade receivables are not met. All right, so this is number 4. And point number 5, advances received from the factoring company is treated as a liability in A Berhad's SFP. Okay, and the fixed interest charges, all right, after 3 months will be treated as a finance cost in A Berhad's SPL. All right, so these are the few things that you need to point out, you need to highlight. The control of trade receivables remains with A Berhad. Advances received from the factoring company is in the form of loan, so it is considered as a full recourse to the seller. Trade receivables will still maintain as an asset in A Berhad's statement of financial position. The recognition of trade receivables are not met. Advances received from the factoring company is treated as a liability in A Berhad's statement of financial position, just like a loan. Okay, loan is also in the liability of the company. All right, so these advances received, it is considered as a loan, so it will be treated as a liability in A. Berhard's SFP. Fixed interest charges after 3 months will be treated as a finance cost in A. Berhard's statement of profit or loss. Okay, so that would be your answer for question 1A. All right, your question 1A, yeah? Okay, then now we move on to question 1B. Basically, question 1B, it is the same as question 1A. All right, the only thing that you need to also do is to gather evidence from the information. This is the first thing that you need to start off. So the first thing, C. Berhad entered into factoring agreement with D due to cash shortage issue. Okay, in accordance with the agreement, D Factories and Ran Berhad paid a fixed amount for the receivables. Okay, so factoring company paid a fixed amount of receivables. All right. And another thing is C. Berhad had no rights to collect further sum from the factor. Okay, C. Berhad had no rights to collect further sum from the factor. So after you have collected these two evidence again and again, you will need to consider the two factors as above. All right, so the two factors here, the control of the receivables, is it still maintaining in C. Berhad companies, or basically D Factorings and Ran Berhad owns the whole receivables? Now, according to the evidence gathered, factoring company paid a fixed amount of receivables and C. Berhad had no rights to collect further sum from the factor. So this is considered as a one-off payment. All right, so since this is a one-off payment, the control of the receivables basically transferred to the factoring Sendirian Berhad. Okay, so it involves a loss of control here. And whether this amount from the factoring company is received in the form of loan or not. So according to your evidence gathered, according to your control of the receivables, this is not a loan. Okay, so after you have gathered your two factors, you can already start creating your very own hypothesis again. Okay, so your hypothesis here, the first information, it will be control of the receivables has already been transferred to the factoring Sendirian Berhad. The recognition of trade receivables are met. Okay, so it has been recognized from C. Berhad's statement of financial position. All right, when we mentioned about the recognition of trade receivables, simply means that it has already been derecognized or it has already been offset from the statement of financial position of a company. So C. Berhad has no longer, under C. Berhad's statement of financial position, did no longer appear the word trade receivables anymore because it's considered as fully settled. Okay, so the next one, advances received is not a loan, but a one-off payment made for settlement of trade receivables in C. Berhad's SFP. Okay, so the advances received is not a loan, but it is a one-off payment made for settlement of trade receivables in C. Berhad's statement of financial position. Okay, so this is considered as a no recourse to the seller. All right, no recourse means this is not in the form of assistance. This is considered as a sale. All right, so it's considered as a sale. All right, so it's not an assistance. All right, for loan, this is different. This is considered as an assistance because the trade receivable still belongs to A. Berhad. But for question 1B, this is not considered as an assistance. It's considered as a trading business already. Okay, so the last one will be your trade receivables in C. Berhad's SFP will be recognized from the accounts. Okay, so since the derecognition are met, so trade receivables in C. Berhard's SFP will be derecognized from the accounts. So that's it for your question 1A and 1B. Can you relate, understand on this part? Can raise your hand if it's simple. Can understand, huh? Okay, thank you. So can understand, huh? Can understand, then I will move on already. All right, so now we will move on to question number 2. Question number 2, basically we have fair value through other comprehensive income and fair value through profit or loss. Okay, so before I move on to teach on this part, so let's just try to understand a bit about what is going on here. So Bonnie Berhad purchased 20 million RM1 listed equity shares at a price of RM4 per share. Transaction costs were 200,000 at the year end of 31st December. Oops, sorry, yeah. Okay, sorry, yeah. All right, so this is in the form of equity instruments. This is in the form of equity instruments because this is a listed equity shares at the price of RM4 per share. So according to Bonnie Berhad, they have purchased 20 million. Okay, so equity shares is basically an equity instrument, all right, because this is in the form of share capital. But if let's say another company purchase another company's shares, all right, this is considered as a financial asset to the company. All right, so not to confuse you further, so if let's say A company purchase B company's shares, all right, so financial asset is considered as a financial asset to A company. All right, so that is the whole idea of these financial instruments. Okay, so according to IFRS 9 financial instruments, we are also required to measure at either fair value through profit or loss or fair value through other comprehensive income. So fair value through profit or loss and fair value through other comprehensive income, because this is an equity instrument. Now, of course, on Wednesday, when you learn about this term of financial assets, there are a lot of different types of financial assets here. Some of the financial assets, basically, you cannot apply these two methods. However, for this equity instruments, basically, you can apply to these two methods. Why? Because there is an active market. So whenever there is an active market, always remember, you can always just rely on the fair value information. Okay, you can calculate fair value because there is an active market, easy for you to identify the fair value. But certain items, certain financial assets, you basically cannot use fair value. Example, trade receivables. Trade receivables is also a financial asset to the company. However, it is difficult for us to measure the fair value of trade receivables. Why? The main idea is because there is no active market for trade receivables. Each and every company's trade receivables are unique on its own. Okay, so that's why it is not measurable at fair value. But for these equity shares, yes, you can measure at fair value, but either at fair value through profit or loss or fair value through other comprehensive income. So how do you want to measure at fair value through profit or loss? So the only thing that we can identify is that if this is a short-term investment, yes, you will classify it under fair value through profit or loss. However, if let's say this is a long-term investment, then you classify it under fair value through other comprehensive income. Okay, so how do we define short-term or long-term investment? Short-term investment means I only hold for a short period of time. I will sell it someday. Long-term investment means I will hold for more than 1 year or maybe 2, 3, 4, 5, 6. I'm not sure. All right. But I know that I want to hold the shares for long. All right. For long-term investment. I don't have intention to sell immediately. That is long-term investment. So that was how we identify for equity shares, all right, whether we want to measure at true profit or loss or other comprehensive income. Now, if you notice the mechanism, how it works, right, it is very simple or similar to your IAS 40, all right, for short-term investment, and for your true other comprehensive income, IAS 16. Basically, they are very similar to one another. Why am I quoting this? Because I want to make it easy for all of you to remember. Now, for short-term investment, you know that IAS 40 investment properties, you also hold the property for short-term investment. It is not for long-term investment, correct or not? When you hold something for investment purposes, all right, you classify under IAS 40, all right, this is also for short-term investment. And any gain or losses on valuation, where will you charge it? You straight away charge out to profit or loss account. So the mechanism actually works the same. For short-term investment, also every gain or losses, you will charge to profit or loss. Okay, but for fair value through other comprehensive income, I am quoting that it is similar to IAS 16 in terms of revaluation model. Okay, as for IAS 40, it will be in terms of your fair value model. All right, so this IAS 16 revaluation model in your property, plant, and equipment, if all of you still remember, okay, so you have your revaluation. In the event that it is an increase in revaluation, where you classify it under other comprehensive income, correct or not? You have your revaluation surplus, and this revaluation surplus will be classified under OCI. So this long-term investment for equity instruments or a financial asset to the company, basically it is the same concept. All right, any gain on revaluation, loss on revaluation, it will be classified under OCI, your other comprehensive income. So that's why the mechanism actually works the same. So when you study accounting standards, you don't have to memorize too much. You need to understand the concepts and then the similarities of it. You will be able to relate it back to one another. Basically, the concepts are the same. Just like this factoring. As you can see, the factoring, we are also considering the control of the receivables, the control test here. So the control test, it's also applicable in IFRS 15 and it's also applicable in IFRS 9. All right, so basically it is the same thing. So now we have fair value through profit or loss and fair value through other comprehensive income. So for this part, I hope that it is quite simple for all of you. So profit or loss, because it is a short-term investment, just like your fair value model, investment properties, any gain or losses, you will also charge out to profit or loss. Why? Because you are holding it for a short period of time to earn revenue. So that's why no point for you to capitalize it. So everything you just charge out to P&L. It is the same. For fair value through other comprehensive income, it's a long-term investment. So in accordance with your revaluation model, you will classify it under other comprehensive income. Why? Because property, plant, and equipment, you also have the tendency to hold for a long period of time. Okay, so this is under other comprehensive income. All right, since you have the intention to hold for a long period of time, it is still worthwhile that we capitalize certain things. All right, but for short-term investment, it is no point. No point to capitalize. You might as well just charge it out because we don't know whether within 12 months will you be selling it off. Okay, so that's the whole idea of this IFRS 9 here. All right, so for this question, this explanation, can everyone understand on this part? Can raise your hand if you can understand on this part. Okay, thank you. All right, if can, then I will move on already. Yeah. Okay. So according to the question, basically there were transaction costs, and then you have your shares traded at 550, initially purchased at 4 ringgit. All right, at the end of the year, traded at 550. Dividend 20 cents per share was received on 30th September 2020. Show the financial statement extracts of Bonnie Berhad at 31st December 2020 relating to the investment on the basis that the shares were bought for trading, okay, and the conditions for fair value through other comprehensive income have been met. Okay, so for this question, let's move on now to question 2. Question 2, we start off with fair value through profit or loss. So let me just insert tables first. Alright, so I have fair value through profit or loss. Okay, and then it is very important for me to put my rounding. So here, as all of you notice, any gain or loss will all be charged to statement of profit or loss. So we have statement of profit or loss. According to the question, acquired at 4 ringgit, but you can trade at 550. So you know that in accordance with fair value measurement, basically this is a gain on fair valuation. So you have your gain on valuation or your investment income, okay? And according to the question also, they have dividend received. So I have a dividend received here, all right, or dividend income. And then the question also mentioned they have transaction costs, so I have to take in as well, all right? And what are the items that should reflect on my statement of financial position? All right, for your statement of financial position, of course, I have already mentioned to you, this is a financial asset to a company. So now Bonnie Berhad is a company, so it's a financial asset, so it should classify under non-current assets. All right, so we have non-current assets, okay, and then this will be your investments in equity instruments. All right, so that's it for statement for your fair value through profit or loss. So now let's have a look at how to calculate on the on each of these items. So now share price was 4 ringgit, traded 550. So definitely you have earned 1 ringgit 50 cents from your investment income. So 550 minus RM4, if you sell, if you did not sell, then this is a gain on valuation. Okay, so 20,000 shares. So here you have 30 million. All right, according to the question, they have dividend income as well, 20 cents per share. Okay, so 20 cents per share, you have 20 million shares. All right, times RM 20 cents. All right, so how much you get? You will have 4 million. All right, the next question, transaction cost. So this is an expenses to the company. So it will be a negative 200 expenses. All right, so that was it for your statement of profit or loss. As for your statement of financial position, then this is very clear cut already. 550 per share times 20 million shares. All right, so it will be 110 million. Why I just take in 550 as a whole? The main reason is because before fair value, all right, your investments in equity instruments will be 4 per share times 20 million shares. So it will be amounting to 80 million. All right, so now you have your investment income, which is your increase in or your gain in valuation, increase in valuation or gain in valuation. So after I have taken in this figure definitely you know you have to debit your NCA, right? Your NCA, investments in equity instruments. All right, and then you credit your investment income in your SPL. All right, so these are the double entries, 30,000, 30 million and 30 million. All right, this is also 30 million. All right, so after you have taken in this figure, your debit side, 30 million plus 80 million, that's how you get 110 million. Okay, so this is the reason why you can just rely on the figure as a whole. that was it for your fair value through profit or loss. Now we will focus on fair value through other comprehensive income. Okay, so I have my fair value through other comprehensive income. So my fair value through other comprehensive income, basically, I also have dividend income. So this dividend income maintains. All right, but then I will have additional items already, which is my other comprehensive income. Okay, my other comprehensive income. And then, of course, I have my gain on investment, which is your revaluation surplus. Okay, so you have 20 million shares times RM550 minus RM4 and minus another RM 200,000. Now this I will explain to you why. Okay, so basically your other comprehensive income, it will be 29,800,000. Your statement of financial position remains unchanged. Okay, so for this part, if all of you are confused, never mind. Let's start off with initial measurement. Okay, you can also use it to do some cross-checking, some sanity check to ensure that your figure is correct. So let's start off with initial measurement. Initial measurement in your SFP. Okay, so you have your investments in equity instruments. Basically, you already have the figure. So it's amounting to 20 million shares times RM4 per share. All right, and add RM 200,000 of your transaction cost. So it's equivalent to 80,200,000. Some of my students ask me, teacher, this is a transaction cost, expenses. It should be minus, why plus? Okay, so the mechanism is that investment in equity instruments is in non-current assets. Assets is debit side. Expenses is also debit side. So when debit meets debit, what you do? You plus. Okay, so that's the whole rationale why you have to add. All right, so that was initial measurement. So subsequent measurement, all right, in your SFP, so your investment in equity instruments, you already have your figure, 110 million. Okay, so your gain on investment will be 110 million minus RM 80,200,000. So what you get, you will get 29,800,000. Okay, so if you are not clear about this calculation, then I will advise you to do the long cut. Okay, the long way, whereby you have your initial measurement and you have your subsequent measurement. Okay, to derive to your gain on investment. If you are very clear with the calculation, you know why, then you can use this method. Okay, so some of the students, they are quite confused on this part. Teacher, why this part is plus and then this part is minus so vice versa. All right, so this is what? Income. Income is credit side. So this is expenses, right? Expenses is debit side. So when credit meets debit, what you do? You minus. Okay, so that's the whole rationale of it. So if you are very confused about this part, then I will suggest that you just move on with the long method. Okay, so that was it for your question 2. Any question that you want to ask me? Can raise your hand if you are clear about this part. No raise hand, so which means not clear. Bing Xiong raise hand. Okay, so it's clear, yeah? All right, if it's clear, then let's move on already, yeah? Now, the next question, basically, it's about a financial liability. Okay. Let me just... Okay, question 3, we are talking about financial liability, yeah? All right, what is financial liability? Financial liability, number 1, it's a present obligation, of course, because this is a liability, arises from past event. All right, it's always as usual. And of course, the conditions are unfavorable. All right. Why conditions are unfavorable? Because this is a present obligation arises from past event whereby you are expected to settle. Okay, expected to settle. Okay, so in the event that you have to settle but you are unable to settle, of course, the condition set will be unfavorable. Okay, so that was financial liability. Okay, that was financial liability. So here we have 6% loan notes with a nominal value of 200 million. Okay, so let's move on. Okay, so this is a 6% loan note, 6% loan note with a nominal value of 200 million. Okay, so loan note, you already know that this is a financial liability. Okay, so this 6% loan notes, it denotes a financial liability. Okay, so what are the conditions that are unfavorable here? Okay, so let's have a look. So by right, this is 6%. According to the question, all right, they are issued at 5% discount and 1.7 million of issue costs are incurred. Loan notes will be repayable at a premium of 10% after 4 years. The effective interest rate is 10%. Okay, so according to the question, without the involvement of conditions that are unfavorable, what you do, it will become 10% loan note. All right. But now with these conditions that are unfavorable, it becomes 6% loan notes. So what are the conditions that are unfavorable here? By right, Star Trek is entitled to receive RM 200 million. However, it was issued at 5% discount. So which means you know that you will receive 5% lesser. Instead of 200 million, you will only be able to receive 95% of this 200 million. So these are considered as the conditions that are unfavorable. Another thing is 1.7 million issue cost to be borne by the borrower. All right, so the borrower is Star Trek. Okay, so 1.7 million issue cost will be borne by the borrower. Okay, you have already received 95% lesser, 5% lesser. You only receive 95%, and yet you still have to bond this 1.7 million, whereby at the end of the day, ended up you will receive even lower money. All right, lower sum. So these are the two conditions that are unfavorable. The third conditions that are unfavorable, interest paid to lender is based on full sum of 200 million. Okay, so which means it will be at 6% times 200 million. You only receive 95%. Okay, and you will also have to bond the cost, the issue cost of 1.7 million. However, the interest paid to lender is based on full sum of 200 million. All right, so this is also considered as conditions that are unfavorable. All right, so these are the few things that I would like to highlight to all of you, that a financial liability, it involves a conditions that are unfavorable in order to settle the liability. So these are the conditions that are unfavorable to Star Trek Berhad. Okay, so without the involvement, it will be 10% loan note. So sometimes when we have a lower interest percentage, it doesn't mean that it is favorable to the borrower. We also have to measure the pros and cons on the unfavorable condition. Yes, to this company, another thing that I want to highlight, this company, they also mentioned that at the end of the day, settlement at 10% premium. So which means you have to pay RM 200 million times another 10%. Not to say times that, it's plus another 10% of RM 200 million. So as you can see here, these are the four conditions that are unfavorable in order for Star Trek Berhad to receive a loan whereby they only charge 6% of interest. From 10% becomes 6%. So the 4% basically it was exchanged through all these unfavorable conditions. So this is a financial liability. Okay, so now according to this question, they are asking how do you want to show the amount in the statement of profit or loss, which means you want to show the finance cost and you want to show the loan amount at the end of years 1 to 4. Okay, so let's have a look. Okay, so here I have year and then I have my SPL, all right, which refers to my finance cost. Okay, so finance cost is at 10%, whereby we ignore the 6% or we ignore all the unfavorable conditions totally. Because without these unfavorable conditions, whereby the lender can actually give you 6%, the loan note should be payable at 10% on the interest portion. So that's why in your SPL, you will have to take in 10% as well. Okay, and then I have SFP, okay, which is my 6% loan notes position. All right, so here, so I have 1, 2, 3, and 4. Okay, so how do you want to calculate this part? All right, so here we have another table to tabulate on the portion. Okay, so of course, this is quite similar to your calculation of reducing balance method. All right, basically it is the same thing. So again and again, I want to tell all of you one more time, all right, that we only receive 95% and we have to bear 1.7 million of issue cost. Now here, another part that my students, they will get confused. They will ask me, teacher, why this part is minus? Just now you plus, right? This part you plus, this part you plus, why this part you minus? Okay, so again, this is a financial liability. Liability is credit side. Okay, this is issue cost, expenses. Expenses is debit side. When credit meets debit, what you do? Minus. Okay, so that's the whole idea why lah. So your capital balance will be 188,300. Okay, so you have your interest, your SPL interest at 10%, and this 10% will be based on 188,300. All right, so here is 18830 and less interest paid. As I have mentioned, interest paid will be based on 6% times 200 million. All right, so this is minus 12 million. Okay, so your year one will be 195,130. So here 195,130. Your finance cost will be 18830. Okay, so basically this is your year two opening balance. So your year two opening balance 195,130, and then same thing, you have to calculate your interest. You have to calculate your interest at 10% and interest at 6%. Now interest at 6% is always the same. It will not change. But your interest at 10%, it will change based on your figure, your opening balance figure. So now it's 19513. Okay, so here your balance will be 202,643. All right, so for your year, wait, let me just pull it down so that it's easier for everyone to see it. Okay, so here your year two opening balance 195,130, your interest will be 19513, 19513, and your 6% loan note will be 202,643. Okay, So now same thing for your year 3. This is your year 3 opening balance. Okay, so you still have to tabulate your interest and your interest paid as well. All right, interest of 10% will be based on 202,643, and your interest paid will be 12 million, which is the same. Okay, so this is 20264, 20264. Okay, so you can put 20264.3 also, up to you. All right, so I just use 20264. Okay, so the figure will be 210907. So for your year 3, 20264, and for your 6% will be 210907. And as you can see for your year 4, this is your year 4 opening balance. Okay, so you still have your interest, all right, your last interest, and this I won't use calculation. Okay, I won't use the 10% of 210907, but I will regard this as a balancing figure. All right, the last interest paid will be the same, 12 million. Okay, so your interest, your so-called balancing figure will be 21093. Okay, out by slightly a little bit. At the end of the day, this will be the amount that you are repaying, 220 million. So capital repayment at 10% premium. So at the end of year 4, you have to make repayment. Okay, less capital plus premium repayment. Okay, so minus 220 million. So you will get 0. Okay, so the last year 4 interest that you have to charge, 21093, and there won't be any figure left, okay, for your SFP. All right, so that's basically how you tabulate for your financial liability. Okay, so your interest, it will be based on the opening balance. Payment will be just a normal one. Okay, if it's 6%, 6% times your loan, okay, loan that you are entitled to receive, and it is stagnant every year. The only thing that changes is based on your 10%, which is we regard it as a present value. But basically, based on my explanation, as I have mentioned to you, without all this involvement of these conditions that are unfavorable, it should be 10%. But because you have already added in all the conditions that are unfavorable, the lender agreed to only charge you 6%. So this 4%, basically, it is because of all these conditions that are unfavorable. So if you calculate correctly, basically lender will still earn, all right? Lender will still gain profit, okay? Maybe a slightly lower profit only, okay? But they still gain. But from Star Trek position, they might believe that they will still gain, okay? Because they have already saved 4% of interest considered as gaining. So every single year they gain 4%, 4%, 4%, 4%. At the end of 4 years, they make a repayment. But to them, the cash flow has already been saved, okay? Because we pay 4% lesser in terms of interest. All right, so that was it for your financial liability. Any question that you want to ask me? Everyone can understand on this part? Can raise your hand if you can understand on this part. Okay, thank you. So if you can understand, no questions to ask me, yeah? Okay, so if no questions to ask me, thank you very much, everyone. I'll see you on Wednesday. I should be able to release all your test 2 results by this week, okay? And then for those who are eligible to sit for Make Good test, so please be prepared, all right? Your Make Good test will be on week 12. So week 12, I will make it on Saturday. We will start as early as 9 a.m. Okay, Saturday, week 12, Saturday, 9 a.m. to 10:30 a.m. Okay, 3 questions, the same thing, 40 marks, 3 questions. All right, cover until this topic, IFRS 9 financial instruments. All right, thank you very much, everyone. Have a nice day and bye-bye. Thank you, bye-bye. Thank you, bye-bye, bye-bye. Thank you, bye-bye.